All right, let's get right into it. Today, we're digging into a really interesting, maybe even a little controversial idea that basically flips a huge rule of investing completely on its head. We're going to explore the argument that if you really want to build wealth, you might have to do the exact opposite of everything you've ever been told.
So let me just start with a question for you. Have you ever stopped to think that your portfolio, the one you've carefully diversified to be safe, might actually be the very thing that's holding you back? It's a wild thought, I know, but it's at the core of what we're going to unpack today. And look, this isn't some crazy idea from the fringes. As our source material points out, you've got legends like Warren Buffett saying things like this. This quote just perfectly sets the stage. The idea that having real conviction in a few great assets is way better than just spraying your money everywhere and hoping for the best.
Okay, so let's jump into this first section, which the source calls the diversification trap. We're going to break down why spreading your money too thin isn't just kind of inefficient. It can actually be a huge obstacle to building serious wealth.
Now this right here, this slide frames the whole debate perfectly. The argument is that these are two completely different tools for two completely different jobs. You use concentration like an engine. It's what you use to build a fortune. But diversification? That's the armor you put on to protect that fortune once you have it. The trap is when you're trying to use the armor when you should be hitting the gas on the engine.
And yeah, the source really doesn't pull any punches. Calling a portfolio with 50 or 60 different stocks 60 pieces of poop is, designed to shock you a little. But the point is clear. If you own a tiny little bit of everything, you probably own a lot of mediocre stuff that's just going to weigh you down.
So if diversification is the trap, what's the alternative? Well, this next section, the power of concentration, gets into the actual math to show why a focused strategy can create these massive gains that a diversified portfolio just can't.
And this just illustrates the point so well. I mean, look at scenario A. Let's say you get one right. A stock triples. Awesome, right? But it's such a tiny piece of your portfolio, it barely moves the needle. And if a bunch of your other tiny bets go bust, you get totally wiped out. Now look at scenario B. You put half your money on that same winner, and boom, you double your entire portfolio. The risk is obviously way higher, but the reward is on a totally different planet.
So the whole game is about finding those winners. And this number is just wild. Out of almost 30,000 US stocks over nearly a century, just 86 of them, that's a tiny 0.3%, created half of all the net wealth. The other 97%, they actually performed worse than just sticking your money in super safe government T-bills.
And this right here, this is the big catch, isn't it? This whole strategy isn't about just blindly YOLOing all your money into one thing. It's about putting in the serious work to figure out which assets have a real shot at being in that exclusive 0.3% club. That's the real skill.
Okay, so that's the theory, but how does this actually look in the real world? This next part gives us a great practical example of how you might use this kind of concentrated thinking around a huge market event, like a really hyped-up IPO. First, we got to get our heads around this key term, the proxy play. It's basically a sneaky backdoor way to invest in a massive private company before it ever goes public. You're buying stock in a company that's already public, but that company owns a big piece of the private company you're really after. And here's the playbook. Step 1. In the months leading up to the big IPO, the proxy stock usually climbs as all the excitement builds. Step 2. As soon as the real IPO happens, you see money rush out of the proxy and into the brand new stock. So, step 3. The smart move is to have a layered exit. You sell off your proxy stock in chunks around the IPO event to make sure you lock in those profits. It's all about knowing your exit before you even get in.
Now, this is hugely important. If you're going to make big, concentrated bets, you absolutely, positively have to get good at spotting the fakes, which brings us to a super critical skill: how to see and avoid the scams that are always out there trying to trick investors. And here's another beautifully simple, if a little crude, rule of thumb. When something is shilled, it just means it's being promoted nonstop, usually because the person promoting it has something to gain. So if you see some project getting pushed on you hard, day after day, be super suspicious. The source says that great things tend to sell themselves. They don't need that constant, desperate push.
So what should you be looking for? Well, watch out for projects that seem way more interested in recruiting new people with referral bonuses than they are in their actual product, or projects that promise some kind of white glove, super easy service for something that's known to be incredibly complicated, like crypto mining. And a huge one, if you can't get a straight answer about who actually holds or controls the assets. These are all classic warning signs of a pyramid or Ponzi scheme.
And this This is the million-dollar question you should always ask. Seriously, if someone has a machine that just prints money, why in the world would they rent it out to you for a small fee? It just doesn't make sense. They've used it themselves and get rich. It's a simple logic check that cuts through so much of the hype.
That idea of checking for real value is the perfect bridge to our final section. Because as we look ahead, the source argues that our whole idea of what's valuable is about to get a major shakeup, thanks to AI, scarcity, and digital assets like Bitcoin.
Now here's a pretty wild thought. In the not-so-distant future, AI agents are going to need to pay each other for services. But an AI can't just go open a checking account, right? The argument here is that they'll use these permissionless crypto-based systems, think stablecoins, to create a whole new machine-to-machine economy that we humans aren't even really a part of.
And this all leads to what the source calls the post-scarcity paradox. As AI and robots make all the physical stuff, cars, food, gadgets, super cheap and super abundant, our definition of what's valuable is going to flip. The things that can't be copied, the assets that are truly, verifiably scarce, those are the things that are going to become incredibly valuable. And this chart just lays out that scarcity argument perfectly. You've got about 65 million millionaires on Earth, but there will only ever be about 15 million or so accessible Bitcoin. There's just not enough to go around, not even for every millionaire to own a single one. This really helps you visualize that supply and demand crunch.
So we're going to leave you with this final question to chew on. As AI creates a world where almost anything can be copied infinitely, what do we decide is truly valuable? Figuring out the answer to that and being able to spot what is truly uncopyably scarce, well, that might just be the most important investment skill of the next generation.